You ever look at a company's financials and just feel like you're missing the real story? Well, today we're pulling back the curtain on the big secrets your standard balance sheet just can't tell you. All right, let me throw a question at you. Imagine a tech company's star coder, the genius behind their best product, suddenly quits. Now, on paper, nothing's changed. The bank account looks exactly the same. But you know deep down that the company just lost a ton of value. The big question is, how do you even begin to measure something like that?
And that right there is the big problem we're talking about today. See, traditional accounting is fantastic for things you can touch and count: cash, buildings, inventory. But in today's world, a company's most valuable assets are often invisible. We're talking about the talent of its team, its reputation, its impact. So we're going to explore 3 modern ways to measure what really counts.
Okay, so here's our game plan. We'll kick things off with what old school accounting misses. Then, we're going to dive into 3 big ideas: how to value people, how to be a financial detective, and how to grade a company's real-world impact. We'll see how investors use these tools in the wild, and then wrap up with a few common mistakes to avoid. So let's get into our first big idea. All right, our first big idea, and this one's a little radical, is putting a price on people. This is the world of human resource accounting, or HRA for short. So what is HRA? Well, put simply, it's a method for identifying and actually measuring the value of a company's team. It's about a huge mental shift, from seeing people as a cost on a spreadsheet to seeing them as a valuable asset that you invest in.
And you can really see the difference in thinking here, right? The old way just sees employees as an expense, a number on the payroll that reduces profit. But the new HRA approach completely flips that on its head. It says your people, their skills, their teamwork, that's the engine of the whole company. They're an asset that can grow and become more valuable over time.
Okay, so how does this actually work? Let's take one method called the replacement cost approach. Let's go back to that star coder who quit. To figure out the true cost, you can't just look at their salary. You have to add up all the recruiter fees, the dozens of hours your team wastes on interviews, the months of training for a new person, and the huge hit to productivity while that chair is empty. Now look, putting an exact dollar amount on a human being is obviously controversial, and it's really hard to do. But this approach at least starts to show the massive hidden financial hit of losing your best people.
All right, let's shift gears to our second big idea. And this one feels like it's straight out of a crime show. We're talking about uncovering the hidden truth in the numbers through forensic accounting.
Forensic accounting is basically where accounting, auditing, and detective work all come together. It's a super specialized skill that's used to dig deep into financial records when something just doesn't feel right. The whole point is to find hard evidence of fraud or other funny business that can actually hold up in court.
Honestly, the best way to think about it is like CSI, but for money. When there's a financial crime scene, someone suspects fraud or money is just vanishing, these are the experts who come in to dust for fingerprints on the digital ledgers and follow the money trail. For example, think about a messy business divorce, right? One partner is trying to hide assets from the other. A forensic accountant gets hired to follow the digital breadcrumbs. They're looking for red flags like huge payments to a company that doesn't seem to exist, or weird transactions happening at 2 in the morning on a Sunday. Their job isn't just to find the money, it's to build a rock-solid case that can be used as evidence. Okay, on to our third and final big idea. This one's about giving a company a report card, not just for how much money it makes, but for its overall impact on the world. This is what we call sustainability accounting. And at the core of all this is something you've probably heard of: ESG. This framework breaks down a company's performance into 3 big buckets: environmental, social, and governance. It's really just a structured way to measure how a company deals with the planet, with people, and with its own rules. So what do these letters actually stand for? Let's break it down. The E is for environmental. That's things like pollution, waste, and energy use. The S is for social. That's all about how a company treats its employees, its customers, and the communities it operates in. And G is for governance, which is all about ethical leadership, transparency, and having strong anti-corruption rules. It's basically a full 360-degree look at a company's character. Okay, so we've got these 3 really powerful ideas, but how do they all come together in the real world? Let's look at how a smart investor actually makes a decision. Let's put ourselves in the shoes of a venture capitalist looking at a brand new startup. They're not just going to look at the sales forecast. First, using HRA thinking, they're going to assess the team. Are these founders irreplaceable geniuses?
Second, they might use some forensic techniques to check for any skeletons in the financial closet. And third, they're going to use an ESG lens to look at the mission. Is this company built to last because it's responsible? It's all about getting the complete picture. And finally, before we wrap up, let's talk about a couple of common traps you'll want to avoid when you're thinking about a business this way. The first big mistake is still thinking of people as just an expense. As we've seen, that's just an old, dangerous way of thinking in an economy where your talent is your #1 asset. The second mistake? Dismissing all this ESG stuff as just fluffy PR. The reality is, investors and customers today demand this stuff. Ignoring ESG isn't just bad for the planet anymore. It's actually becoming bad for your bottom line. So, look, if there's one thing you walk away with today, let it be this. Modern accounting isn't just about counting the money anymore. It's about measuring what truly matters: your people, your integrity, and your impact. So, I want to leave you with a question. The next time you look at a company, are you just going to ask how much money it makes, or are you going to dig a little deeper and ask what it's truly worth? That's the question that really matters.